Chapter 1, Part 3, Forms of Organization. The finance function may be carried out within a number of different forms of organization. The sole proprietorship, which is a single ownership, offers simplicity of decision-making, low organizational and operating costs, unlimited liability, and earnings are taxed as personal earnings of the individual owner. Then we move to the partnership. Two or more partners, usually formed by articles of partnership agreement, unlimited liability for all partners unless a limited partnership is formed, which provides limited liability for one or more partners, with at least one partner being a general partner. Earnings are taxed as personal earnings of the partners, and special forms of partnerships such as a limited partnership and the limited liability partnership can be used to circumvent the liability issue of partnerships. Let's move to corporations. They're the most important form of business in terms of revenue and profits. They're a legal entity. They're formed by articles of incorporation. Stockholders are the owners and have limited liability. The ownership, it has easy divisibility. It's managed by a board of governors. It has double taxation of earnings because the earnings of the corporation are subject to a corporate income tax. The dividends, distributed net income, are subject to personal taxation. And Subchapter S corporations, however, avoid the double taxation disadvantage, but S corporations are limited to 75 shareholders. And then there are limited liability corporations. Let's just go back here for a second. Limited liability corporations are popular for their highly flexible structure. They provide limited liability for owners. They're not technically a corporation, and they can be taxed in many different ways that would be elected by the owners. Moving to corporate governance, Enron and other failures of corporate governance are discussed throughout this text. During the last decade, much attention has been devoted to the relationship between the owners of the firm and the managers of the firm. In large corporations, the hired management acts as agents for owners. The study of the relationship between owners and managers, as well as other agent relationships, is referred to as agency theory. Included in agency theory is a trend that developed in the 1960s for large institutional shareholders to exert pressure on management to be responsive to shareholder goals. Institutional investors have more and more impact on decisions made by corporate boards of directors. And then finally, the Sarbanes-Oxley Act imposed greater accountability on corporate executives and independent auditors. It has also created additional compliance burdens on publicly traded companies. See you again in Chapter 1, Part 4.